This week's news offered headlines and head fakes that left investors disappointed and frightened. On Tuesday, the Dow plunged 800 points. The market was closed on Wednesday, and selling continued on the open on Thursday. As always, the financial media had ready rearview mirror explanations and frightening predictions about future disaster. The only problem is the media's poor track record of predictions. Without a doubt, the market is at a critical juncture, where it remains to be seen if it is forming a bottom or trading sideways before another leg down. At times like these, a signal or an observable truth in the market upon which we can base an investment decision is more important than ever. This week, we'll focus on the importance of reacting to reliable signals versus anticipating or predicting outcomes. First, we'll look at the summary of this week's economic data and interpretation. This was a full week for economic data reports, with most of the highly anticipated readouts in the latter half of the week. Important highlights include a decline in initial claims, strong ISM numbers, and a weaker than expected non-farm payrolls, which ironically helped slow the Fed. Any non-farm payroll read over 80,000 to 100,000 is still sufficient for surplus job creation for new labor market participants. But again, the number was weaker than expected. Overall, the readings point to strength in the economy, and the outlook for near-term recession remains quite low. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, the market gapped up strongly at the open on weekend news of the trade truce, only to be faded in the first 15 minutes through the end of the day. On Tuesday, the markets fell precipitously as questions about the substance of any trade agreement swirled and the yield curve narrowed. On Wednesday, the markets were closed to honor and mourn the passing of George H.W. Bush, our 41st president. On Thursday, the market saw an incredibly volatile day, where a steep sell-off was nearly fully reversed by news that the Fed was going to adopt a more cautious approach to rate hikes. On Friday, the market attempted follow-through on the rally, encouraged by comments from Larry Kudlow on optimism regarding negotiations with China and comments that negotiations could be extended beyond the 90 days. The rally failed and reversed on hawkish comments from Peter Navarro, reiterating the threat of tariffs should there not be an agreement within 90 days. The market is now down 1.2% for the year, and the week and month-to-date statistics are provided at lower right. There were many headlines this week about issues that have been weighing heavily on the market. Last week, Chairman Powell of the Federal Reserve struck a more data-dependent tone. The market went higher until a closer analysis of his statement showed no change in where he viewed the neutral rate. The market gapped up on Monday, buoyed by news of a truce between the U.S. and China on trade, only to sink as no concrete details emerged and conflicting statements were made. With good news on rates and trade in question, doubts about growth came back to the forefront as investors began wondering if the economy has peaked. Another hallmark of a pending slowdown is the ratio of corporate debt to GDP and slowing demand for higher yield corporate debt. The fall in oil prices dragged the high yield sector down further, as some 15% of the sector is comprised of oil companies. And finally, stories swirled about the yield curve potentially inverting, which is a topic we haven't covered in a few months. We'll look at the implications in this video, along with a look at slowing growth. This is our leading and coinciding economic index dashboard, which uses economic indicators tracked by the Conference Board to create an indicator of the momentum of economic growth. Remember, the stock market is forward-looking and often turns down 6 to 8 months in advance of the economy. Currently, we see the leading economic indicators at a cycle high. However, as we've shown in previous videos, our smoothed momentum indicator has continued to slow down. This indicator does not have to continue falling. In fact, history shows that declines like this before have been followed by increases. The signal on this indicator occurs when this line falls below zero. Going back to 1969, the indicator typically falls below zero on average 6 months prior to a recession. As we discussed in our opening quote, the key is waiting for the signal versus acting on anticipation of a preconceived notion of the outcome. Another example of anticipating the outcome and appealing to fearful emotions versus waiting with discipline for the signal has been the media's coverage of the yield curve. We've covered the yield curve in previous videos, but a brief review is in order. A normal yield curve is upward sloping, with a higher yield for a longer length of maturity. Buying treasuries from the U.S. government is essentially lending the government money. If you lend money for 10 years instead of 2 years, you would expect to receive greater yield for more time and risk that things could go wrong. When the yield curve inverts and yields are lower on 10-year treasuries, it means investors are expecting a recession. Demand for longer-dated bonds increases and their yields fall. This week, a portion of the yield curve, the difference between 5-year yields and 3-year yields, did invert. But the more widely watched is the 10 and 2-year, which is not yet inverted and is a better signal of coming recession, which we'll be using on the next slide. This slide shows the ratio of the 2-year Treasury yield to the 10-year yield. We use this to chart an inversion of the yield curve. When the ratio of the 10-year to the 2-year crosses this red line, the yield curve is inverted, and a recession usually follows. To read the headlines, you would think that an inversion is a foregone conclusion and will enter a 2008-style recession tomorrow. The yield curve may invert. The Fed may invert it with the December rate hike, and we're well served to pay close attention. But it hasn't happened yet. Why is it important? Because the yield curve has an established track record of signaling recessions 9 out of 9 times since 1957, with an average lead time of 14 months from inversion to recession. So let's take a look at prior yield curve inversions on this chart, which goes back to 1977. We see the first instances of inversions leading to recessions in 1980 and the 1981-82 recessions. The next instance leads to the 1990 recession. Now we're all pretty good at identifying in what direction a line is going and predicting what's going to happen next. In fact, if you were looking at this chart in 1994, the stock market has been a sideways mess, unemployment claims are increasing, and there are significant concerns about the deficit and federal spending. The yield curve has been compressing and getting closer and closer to an inversion. Things are terrible, and you can predict that we're going to cross the red line and tip into recession, in which case you should probably get out of the market now. What happened next? The yield curve didn't invert. In fact, it didn't invert for 5 more years, which was followed by the 2001 recession. If you got out of the market, what did you miss? Here's an inset of the S&P from 1993 through 2000. You see that the market was going sideways, just as we discussed, and the yield curve looked like it was going to invert. If you got out, you missed a 220% gain in the market. Now let's look to the inversion prior to 2008 to where we are today. We're closing in on the red line again. We could anticipate the signal and extrapolate that we'll have a 2019 or 2020 recession, but as we've seen from history, we're better served to wait for the actual signal. From the signal, we usually have 14 months until recession. Going back to the 1950s, the typical gain after an inversion up until the market peak is 20%. We also have to recognize that this is a very small sample set. There's a lot of debate right now over whether or not signals from the bond market have been distorted by central banks. In prior inversions, 10-year yields were around 6% at the time of inversion. Now we're below 3%. There's been unprecedented stimulus by central banks. Central banks pushed investors to seek more yield, and now unwinding of the balance sheet is putting more pressure on the long end, along with Treasury debt issuance to fund the deficit. Despite this debate, the yield curve has been a reliable indicator, and we would pay close attention to an inversion. But as you saw for yourself, close doesn't count. This is not a signal in our model, but if you are using it as a signal with a lead time of 14 months, you have to wait for the signal. Before we look at charts of the S&P, let's look at a history of corrections from 1936 to present. The important takeaway is the average length of a correction is 126 calendar days, and we're only 79 days out from the September 20th high, or 62% the length of the average correction. The other key point is the shape of the correction listed in this column here. The most common shape is a W shape. In the next two charts of the S&P that were produced Friday afternoon prior to the close, we're going to focus on key structures and levels versus probable outcomes. Looking at this daily chart of the S&P, you can see why the statistics we covered in the last slide are important. We have a W shape and a sideways consolidation. Unfortunately, this W shape did not lead us out of the top of the box and is broken down toward the bottom of the box, ending with a bearish candle for the week. The 100-day moving average shown in red aligns with the top of the box and forms clear resistance where previous price advances have been reversed, while we've oscillated above and below the 200-day moving average shown here in green. Coincidentally, the 38.2% Fibonacci retracement from the September high to the October low also lines up with the top of the consolidation box. The 61.8% retracement is not far below the 200-day moving average. There are only two ways out of this consolidation, up or down, and we're prepared for both scenarios. On the plus side, through the correction in early 2018, we did make a series of higher lows. Now we're making higher lows again and holding above the early 2018 lows. Levels below that offer potential support include the November low and the October low, which forms the bottom of the box, and the very bottom line at the February low of 249.66, closing below the consolidation and making lower highs and lower lows to set up a test of the February low would be a very concerning outcome. Looking at our weekly chart, we have our consolidation box here. We'll zoom in using this inset to look at the moving averages. We have no crossovers at the moment and some positive slopes, but we'll want to monitor for further flattening. Let's clean these up and look back at the chart. We had our very concerning bearish engulfing candle in early October that started the sell-off to the October low, and we've stayed above the low so far. Previously, price was in an ascending channel coming out of the 2015-2016 correction and broke out of the channel to the downside, and has made several failed attempts to reclaim the channel, ending with this red engulfing candle for the week. Where did price stop? We can draw a new trend line from the 2016 low to the October and November lows, and this becomes a new line in the sand. Using peaks, outside bars, and gaps that often form diagonal borders of price discovery, we can add additional support lines here and here. If the trend line is broken, these lines create a minor support zone for an attempt to reclaim the trend line. This level projects into next week around 254 to 253. Note that the April low was 252.39 and the February low was 249.66. These are long-term monthly charts that have been very reliable signals of prior corrections in bear markets. We covered these charts in detail in the November 2nd, 2018 video, which you can find by going to the Caliber Capital Management YouTube channel or searching for this title on YouTube. These charts have been worsening since we first covered them. At the moment, the long-term charts, declining bond yields, slowing economic data, and falling stock prices are pointing to the same story of a slowing economy. The market is full of more surprises than anyone can imagine. Perhaps we'll be stunned by a trade agreement that ends the current economic brinksmanship, or perhaps the Fed will deliver something that soothes the markets. Some good news is that the bond market is also sensing that the Fed may pause or do a one and done in December. We can't predict these things, but we can follow a system, be disciplined in risk management, and make incremental changes in allocations as we receive signals to do so. These statements are appropriate for our investment strategy and time horizon. Only your financial advisor can tell you what's appropriate for yours. Next week, we'll keep an eye on what price is telling us about the path out of the current trading range, and we'll patiently wait for a signal. And speaking of signals, as you read these closing quotes, perhaps perseverance also refers to the discipline and prudence that is required to wait for actionable signals in difficult markets. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.